Tariffs didn't fail. Leverage did. This number is not just about 1 month. It is about how much pressure still works. In November 2025, the United States recorded a trade deficit of $56.8 billion. 1 month earlier, the figure stood at $29.2 billion. That is a 94.6% increase in 4 weeks. This is the largest month-to-month jump in the U.S. trade deficit in more than 3 decades. And it happened after nearly a full year of broad tariffs. Tariffs that were explicitly designed to reduce that deficit. The instinctive response is to call this a policy failure. That reaction misses the deeper signal, because the data is not only telling us that the deficit widened, it is telling us something more important about leverage. It is showing how economic pressure is becoming less efficient and more expensive to apply. This is not a political argument. This is analysis based on publicly available data and confirmed events. The question is not whether tariffs are good or bad in theory. The question is what the data says about how they are functioning in practice. And what it says is uncomfortable. The November numbers do not point to a temporary fluctuation. They point to structural friction. They point to rising costs. They point to volatility. They point to shrinking room to maneuver. That matters. Let's start with what is confirmed. According to official U.S. government data, exports fell by 3.6% in November 2025. Imports rose by 5.0% over the same period. That gap alone explains why the deficit widened so sharply. But the headline number is only the surface. The composition of imports matters far more than the total. In of capital goods increased by $7.4 billion. That includes a $6.6 billion increase in computers and roughly a $2.0 billion increase in semiconductors. At the same time, consumer goods imports rose by $9.2 billion. Within that category, pharmaceutical preparations surged by $6.7 billion in a single month. That jump came immediately after a sharp decline in October. That pattern is not normal demand behavior, and it tells us something important about how firms are responding to policy. Before going further, it is important to clarify what a trade deficit is not. It is not a simple scoreboard. It is not proof of exploitation by trading partners. A trade deficit reflects how an economy is structured. It reflects where goods are produced. It reflects where investment flows. And it reflects how supply chains are built. The assumption behind tariffs is straightforward. Make imports more expensive. Domestic production will replace them. The deficit will shrink. That assumption only works if domestic capacity already exists. In many of the sectors driving November's import surge, it does not. Semiconductors, advanced computing, pharmaceutical inputs. These are industries built over decades. You cannot recreate them in a year. You cannot recreate them by price signals alone. So firms keep importing. They just import at higher cost. That is the first structural problem. When costs rise faster than capacity adjusts, competitiveness erodes. That is not ideology. That is arithmetic. When input costs rise, firms face 2 choices. They raise prices, or they absorb losses. Either way, exports become less competitive. That dynamic is visible in the data. Imports rose, exports fell. This does not prove tariffs always reduce exports, but it shows how easily they can. And that matters for leverage. Pressure only works when alternatives are limited. Higher costs create alternatives, even imperfect ones. The second structural problem is substitution. Tariffs assume imports can be replaced. November's data shows replacement was not available at scale. Capital goods imports surged precisely because firms could not substitute domestically. AI infrastructure still requires foreign-made components. Advanced manufacturing still depends on global supply chains. So imports continued at higher cost. That pushes the deficit wider, not narrower. The third structural problem is behavioral. Policy does not just change prices, it changes expectations. And expectations drive behavior long before factories move. This is where volatility enters the picture. Look again at pharmaceuticals. A steep drop in October, a sharp spike in November. There is no evidence U.S. healthcare demand swung that violently. A more plausible explanation is timing. Firms appear to be adjusting shipment schedules around tariff implementation. This is known as front-running. It is not illegal. It is rational, but it distorts data. And it signals something deeper. It signals a lack of confidence in policy stability. When firms plan for 10 or 20 years, they build capacity. When they plan for weeks or months, they arbitrage rules. That shift matters more than the monthly numbers themselves. It tells us that businesses are no longer treating tariffs as a stable framework. They are treating them as a variable to manage around. That undermines long-term investment. And long-term investment is what tariffs claim to encourage. This is not theoretical. Markets respond to this behavior. Higher uncertainty raises the cost of capital. It delays decisions. Delayed decisions mean delayed capacity. And delayed capacity means continued dependence on imports. This is how pressure loops back on itself. Now consider the external response. Trade policy does not operate in isolation. Other countries do not wait passively. They adjust. In November, the U.S. goods deficit with the European Union rose sharply. It increased from $6.3 billion to $14.5 billion in a single month. That increase was driven primarily by higher imports from Europe. This is not just a bilateral data point. It fits a broader pattern. When a major market becomes less predictable, partners hedge. They diversify trade relationships. They accelerate alternative agreements, not because of ideology, because of risk management. This is how leverage erodes quietly, not through confrontation, through adjustment. Once alternatives are built, pressure weakens, and those alternatives do not disappear when policy changes. They persist. This brings us to the legal dimension. The tariffs imposed in 2025 relied on emergency authority. Specifically, they invoked the International Emergency Economic Powers Act. The justification was that persistent trade deficits constituted a national emergency. That interpretation has been challenged in federal court. Lower courts have questioned whether the authority was exceeded. The Supreme Court has agreed to hear key elements of the case. A ruling is expected in 2026. This legal uncertainty compounds the economic uncertainty. Even firms that support tariffs face a problem. They cannot plan around a tool whose durability is unclear. They cannot know which duties will remain or under what authority. That ambiguity discourages large, irreversible investments. And without investment, domestic capacity does not expand. Which brings us back to leverage. Pressure only works when it is predictable. Uncertainty weakens it. Volatility weakens it. Legal ambiguity weakens it, and rising costs weaken it. All of those signals are present in the November data. This does not mean the U.S. economy is collapsing. That claim would be irresponsible. It does mean that tariffs are not delivering clean leverage. They are delivering friction, and friction is expensive. Now look at this from a Canadian perspective. Canada is not a bystander in this system. It is deeply integrated into North American supply chains. It is also exposed to global shifts. When pressure becomes less efficient, middle powers gain space, not because they are stronger, but because coordination matters more. Canada's leverage does not come from confrontation. It comes from predictability. It comes from alignment. When larger powers create uncertainty, smaller ones can position themselves as stable alternatives. That is not ideology. That is strategy. The November trade data should not make Canadians panic. It should make them pay attention because it shows how quickly leverage can shift, not through dramatic announcements, through accumulated costs. The key takeaway is not the size of the deficit. It is the efficiency of pressure. When pressure stops producing results proportional to its cost, it gets used less, or it gets used at higher cost. Either way, its effectiveness declines. That is what the November data is telling us. Not loudly, but clearly. Tariffs did not fail in isolation. Leverage did, and leverage, once lost, is hard to rebuild quickly.